Hi guys, George Baltakian here, real estate professional in Los Angeles. This video I'm going to cover pre-qualification and pre-approval and explain what factors lenders typically look at when they're pre-approving you for a loan to purchase a home. So pre-qualification is usually the first step. It could be done over the phone. The key factors that banks and lenders look at when they want to decide your credit worthiness is your credit score, your job history, and your debt to income ratio. The lender is essentially just taking your word for it to give you a quick idea of how much you would qualify for a home loan or whether you would qualify for a certain program or not. However, pre-qualification has nothing official and there's no thorough documentation being provided to the lender for them to do a full analysis of your situation. With a pre-approval, the bank would do a more thorough analysis of your financial situation to tell you exactly how much you would qualify for as far as a home loan. The lender would ask you to provide documentation such as your recent pay stubs, your tax returns from the last few years, and your bank statements for the past few months. If you're getting a home loan, you need a pre-approval to actually make offers and qualify to purchase the home. So when looking into your job history, lenders want to see consistent employment. Typically, they look for at least 2 years employed. Banks and lenders typically prefer W-2 income of employees over 1099 income of contractors and freelancers. This is because they see it to be slightly more stable and consistent over the long term. This doesn't mean 1099 employees can't get a loan, but it does play a factor with certain types of conventional loans. So finally, banks take a look at your debt to income ratio, or DTI ratio for short. To calculate your DTI, you add up all your monthly debt payments and divide them by your gross monthly income. Keep in mind, gross monthly income means it's before taxes and deductions. So typically with debt to income ratio, the lower the better. And banks really require you to be below 45%. However, most banks for most conventional loans like to see it between 28 to 36%. Keep in mind, every situation is different, and the debt to income ratio that a lender would require to approve you for a loan could change based on your credit score, the savings you have in the bank, and how much money you're planning on paying as a down payment. So the minimum requirements for each of these factors and how they are weighted by the lender in your overall application really depend on your situation, the lender, and the loan program you're applying for. So that was an overview of pre-qualification and pre-approval. I hope that helps. If you have any questions, please reach out to me directly or comment below. Like the video, subscribe to my channel, and I'll see you in the next video.